Good morning, all. Welcome to the Genghis Weekly Investor Briefing. On this briefing, we go through the happenings of last week in the financial markets and what to expect in this new week. With us today, we have Chachi Logutu, who is our head of research at Genghis Capital, and Gerald Morioki, who is a research analyst at Genghis Capital too. In this webinar, for those who are attending for the first time, we are going to have Gerald Morioki will be going through the equities section, and finally we'll finish off with Chachi Logutu, who will go through the fixed income section. And should you have questions, we have the Q&A section down there, or the chat, or you can use the chat to air out your questions, which will be answered at the end of the webinar. Thank you very much for joining us, and over to you, Gerald.
Thank you, Daniel, and good morning, everyone. Let me share my screen.
While at it, kindly raise your voice so that there is some people who are not hearing you well, Gerald.
Okay. I hope that is visible, and I'm loud and clear.
Yes.
So we'll begin with a recap of last week in the financial markets, equities markets. So some very slight movements in terms of the indices. NASI up about 0.5%, and then a C20 at negative 0.3%. So very, very minimal adjustments in the indices and the market performance. Turnover again was very slight, negative, about 5.0%, to Kenya shillings 2.5 billion. So we are still yet to see turnover recover substantially from the ideal averages of about 3 billion on a weekly basis. So we still see some cautiousness in terms of investors coming back to their risk assets. So top gainers last week, NBV, Nairobi Business Ventures, Kengen, and Unga Group. You see Kengen there because they released some very, very solid results for last year. Then top losers, KPLC, Home Africa, and Portland Cement. So basically the retail kind of stocks. And then the top traded, the usual Safaricom, KCB, Equity, and EABL. So basically the large cap kind of stocks. In terms of foreign activity, participation came in to about 68.4%. I think the prior week was about 50%. And then there's still some inflows from the foreign end. Last week was about 78 million shillings. But however, this was very skewed towards Safaricom. And you have seen this trend continue for quite a while, from the late part of last year and now in the early part of this year. So a lot of accumulation on Safaricom. However, its price has been coming down because of pressure from the foreign end also. Accumulation, as I've mentioned, Safaricom, and basically exiting from most of the other top traded counters, KCB Group, BAT, EABL, and the Equity Group. And then the top traded are the usual Safaricom, KCB, Equity, EABL. Basically the foreign favorites on a weekly basis, not much change from that end. In terms of where we are trading at against current peers, SSA peers, at about 11.3 times market PE against about 10 times market PE. Yield is about 4.3% against 5.4%, slightly above the African average. And when you look at markets across sub-Saharan Africa last week, a slight movement, basically reflecting the local movement in the markets, about 0.2% on average. But on a year-to-date basis, we're just at about break-even across sub-Saharan Africa. So not much change so far. Trading ideas for the week. A long term, you're still biased towards the strong stocks, especially those that are trading at very discounted levels compared to their fair values and also compared to their historical averages. But this week, our eyes on Kengen, as we highlighted, Kengen was a top gainer last week. We still think there's a lot of value in the stock at the current market price of about 5 shillings. And from the results, we saw some very, very solid results reported at about 133% increase in earnings per share. But when you remove the effect of those one-off tax incentives, you come to a normalized DPS of about 16.7% year on year. So a very, very solid performance against an environment that most businesses are issuing profit warnings and will definitely be cutting back on dividends. So another pointer, dividend was increased by about 20% from compared to the prior year to about 30 cents per share. And we still see the business increasingly invest in its growth. There's a lot of capacity increase initiatives. There's Career One, Unit 6 power plant that is coming on board in the next about 1 year. And then there's also another Career power plant, I think, called Career 5, that will be coming on board in another about 2 to 3 years. So a lot of capacity initiatives over there, the medium and also the long term. And then the other line item that stood out from these results was other income, basically unrelated to electricity. And we saw them generate about 440 million shillings from Ethiopia. I remember last year they had some contract for geothermal drilling, and we are seeing this revenue start trickling in the financial statements. So very solid business. However, the key risks still remain reliant on a single off-taker, that is KPLC. And we all know that KPLC has been under some challenges, and we definitely saw some hit on the cash flow end. And another highlight for speculative investors, you can take profit on Nairobi Business Ventures. You'll note that NBV is up about almost 700% since its suspension was lifted on 1st December. So short-term investors, speculative investors can take some profit from this massive gain. In terms of corporate calendar, from announcements last week, Kengen, as we mentioned, 10 shilling, 0.3 dividend with disclosure in 29th of April. And then Crown General also announced a very solid performance and issued an 80 cent dividend with disclosure on 22nd of February. So we still expect more earnings announcements in the course of the next 2 months. Banking sector is expected to start from next month, March, and most other companies will definitely also be announcing in the next 1 to 2 months. So over to Churchill for the next session. Thank you.
Thank you, Gerald. So I'll walk you through the macroeconomic bits and the fixed income segments. I'll start as usual with the macroeconomic. First, let me just wish everyone a happy new month. It's amazing how the 45 days in January just came and passed like a breeze. So here we are into the new month. So happy new month, everyone who's joined in the call. So I'll start with the review that came out last week. The much awaited third quarter numbers were released last week. There was a decline of 1.1% against the third quarter in 2019. That was hardly surprising, bearing in mind that we were still under the pandemic and some of the aggressive measures to contain the virus were still in place. So that led to that impact. But going forward, we expect that more so with some of the sectors And here we're thinking like education, whereby those are discounting factor that had been applied in the second quarter and the third quarter numbers, which led to the decline in that sector. The sector declined 57% year on year vis-a-vis the previous year. But now with the now that schools have opened back, have fully opened, fourth quarter, there was a gradual reopening for the class 8s, class 4s, and form 4s. But right now, this year, we have the full reopening of schools. At least that will be a boost in the sector and ultimately the overall GDP numbers going forward. So that is expected with the 2021 numbers, whereby you've seen that there's a expected spike against last year's numbers. We had the MPC meeting, which was held last week on Wednesday, and as expected by us and also the consensus across the board, the benchmark rate was written at 7%, and some of the issues that came from the monetary policy statement was that the restructured loan book has ballooned to close to 54% of the overall loan book, and that is a concern which we are flagging because in the event that that restructured loan book are not, the uncertain environment continues into the year, it will have an impact on the restructured loan book into the NPLs. NPLs were elevated at 14% by the month of December. So that is quite a concern, bearing in mind that a significant chunk of the restructured loans were the individual or the household loans. And we are quite worried that in the event that there's no resolution to the COVID-19 pandemic, it will have a negative knock on the NPLs going forward. For inflation rate for the month of January, that was released end of the week. It was at 5.69%, and the other sub-indices like Bitcoin inflation remained subdued at 2.6%. Fuel inflation jumped up slightly, similar with the food inflation, but the overall inflation still went up marginally from 5.6% in December to 5.7% last month. Our expectation was that with the rollout of, rather the reversal of the VAT back to 16%, it will have a significant impact on overall inflation, but that hasn't happened as per expectation. But we will just monitor the inflation numbers, at least for this quarter, to see whether at all that will take effect on inflation. And finally, we are in the budget process, whereby the draft 2021 budget policy statement was released last week, with the public asked to give their comments deadline today. So looking at the numbers, looking at that budget document, because it somehow just takes a review of the current fiscal year and also the outlook for the next financial year. And looking at the current financial year, which is ending June 30th, we are seeing that revenues have been drastically lowered to the tune of 60 billion. That's the ordinary revenue. On the other hand, we are seeing that expenditure has been increased, be it spending to the national government. We are seeing an increase of 73.8 billion, and there's some revisions to what was to be allocated to counties. Initially it was 316, but the budget policy statement has scaled it upwards to 330 billion. So that means that with a decline in revenues and an increase in spending, that means that there's been some pressure on financing, and that is the case. We are seeing financing in the current financial year at 1 trillion is still elevated, and a huge chunk of that will be financed from the domestic borrowing. So that is also another pressure point, even in the private sector credit growth, where we don't see a robust credit mediation to the private sector in the event that now Treasury still comes to borrow a significant amount of monies from domestic market. So that is another pressure point. Going forward with the finalization of the budget policy statement, we'll now put out another note just to look at what are the key issues that will be tackled going forward. But having said that, we are saying that because the budget policy making is a process which started all the way back in August with the budget review outlook paper. And then we had the macro working groups, and there was a public participation back in November. And just looking at what the MDS, by MDS, I mean the ministries, departments, and agencies, what the requirements are in the next financial year, that was totaling 3 trillion shillings. And right now, what has been somehow the ceiling as per the budget policy statement is around 1.9 trillion. So you're saying that going forward, that will be another added headwind in terms of supplementary budgets just being on an increase. So that's another thing that we flagged from the 2021 budget policy statement. In regards to timelines, we expect that after the budget policy statement has been finalized, it's meant to be taken to the cabinet for approval and then and to be tabled by the 15th of February. That will be by next week, ideally Thursday next week. Parliament is resuming on the 8th, on the 9th of February. It usually has its sittings on a Tuesday and Thursday. So most likely the BPS will be tabled in Parliament next week on Thursday, together with the debt management strategy paper for this current year. For this week, it's quite light as compared to last week. We're expecting the Purchasing Managers Index for last month to be released on Wednesday. Looking at where we are, second quarter last year, the average was 39.7 in this particular PMI print. By the end of last year, fourth quarter numbers, the average was 53.9. So obviously there's been some rebound in optimism by the private sector, which feeds into this PMI data. We still expect it to be more or less where we closed at in terms of the headline print. Anything above 50 shows that there's some expansion in sentiment. Anything below 50 is showing that there's some contraction in sentiment, and that also obviously feeds into the private consumption in the GDP numbers. Moving on to the fixed income, last week we saw a ballooning in secondary market activity. There was an increase of 622% week on week to a whooping 34 billion that was traded. A significant portion of that was attributed to the infrastructure bond that was brought into the market last week. That's the IFB1 2021-16. The auction was 2 weeks ago, and it started trading last week on Tuesday. So that was the major factor that led to this ballooning in the secondary market activity. In regards to T-bills, the performance was not satisfactory. It recorded a performance of 66%, or in aggregate terms, that was close to 16 billion. We've noted that yields have been on an increase, increasing on average roughly 1% across the three tenors: 91-day, 182-day T-bill, and 364-day T-bills. Moving on to the liquidity trends, we are seeing that the interbank average interbank rate went up close to 1% last week to average 5.56%. And the CBK's daily intervention activities was biased towards liquidity injection. So these two indicators is somehow signaling that there's a drying up in liquidity, which could affect the T-bills issuance this week if that trend continues. And also there's the primary bond issuance that is expected to be auctioned on Wednesday. So because of the dry up in liquidity, it will have an impact on that. It goes without saying that this marked dry up in liquidity has been because of the mop up of the infrastructure bond last week. CBK sold 50 billion It received 125 billion of bids in the infrastructure bond that was issued 2 weeks ago, but it accepted 81 billion, which is 31 billion over and above what it sought. So that has somehow led to a dry up in liquidity, and that also has resulted in interbank going up and also CBK coming in on a daily basis to try and see ways of injecting liquidity. In regards to net domestic borrowing, factoring now T-bonds, uptake, and the payout of maturities, also the T-bills. From our calculations, we are around 309 billion, thereabout, and comparing to the revised target of 600 billion, that's 51.5%. Speaking of the targets in the financial year, as per the draft 2021 budget policy statement, that target is been lowered slightly to 573 billion. So it's still not as meaningful as what we had hoped that it will be revised down to, but still it remains elevated. 572 billion. Last year we are looking at a target of 410 billion. So it's just telling us that this year is the borrowing is still elevated. Moving on to the week's trade. This is now coming off the primary bond that is on sale. The sale is coming to an end tomorrow, and it's a reopening of two existing papers. The first one is a 15-year paper that was issued in 2013, so formerly known as FXD1 2013-15. And the other one is a 20-year paper that was issued in 2012, so FXD1 2012-20. So right now, the terms to maturity for those two papers is around 7.1 years and 11.8 years respectively. The coupon rates for the bonds are 11.25% and 12% respectively. And looking at the implied yield, where the yields that these papers are trading at is around more or less where their coupon is, 11.23% and 12.07%. And just reiterating the rule of thumbs that when yields is more or less close to coupon, it means that the clean price is 100. So for every 100,000 shillings as an investor you want to invest in either of these bonds, you'll be required now to pay the 100,000. Of course, now some accrued interest over and above the 100,000, but the clean price will be 100,000 because the yield is closer or equal to coupon. In regards to our recommendation, we are saying that because these bonds, we have had discussions with our dealers who sit in fixed income dealers, and from their feedback is that these bonds are quite illiquid. They are not been trading as frequently as other bonds. So expect that there could be some discount on these papers once the auction results are out. So that's where our recommendations, the lower range up until the upper range, are way above where the implied yields are as at now. So you're saying that for the 15-year paper, we are seeing 11.4% to 11.55%. And for the 20-year paper, we're seeing, we are recommending a range between 12.15% to 12.3%. So it will mean that you, as an investor, you'll pay a discount. So for every 100,000 that you intend to invest in these bonds, based on our recommendations, you'll pay lower than the 100,000, excluding the accrued interest. So there's that accrued interest that as an investor you have to pay because these bonds are already trading, and coupon payment is every 6 months. So you'll have to pay the portion of the coupon interest that you are not entitled to. So that will be paid over and above the amount that you will be required to deposit at CBK. So that marks the end of our presentation. So let me hand it over to Dan to take the session.
Yeah, thank you very much, Churchill, and Gerald for your presentation. Now, over to, there's a couple of questions have come in. Shikun Jadi is asking, what do you expect from the Safaricom price now that Citi has downgraded the counter? And the second question is, Kabasid a sure bet once they acquire BOC, which seems very probable. And then the third question is, will KCB entry to Rwanda have any meaningful impact in their earnings? Over to you, Gerald.
Thank you, Daniel, and thank you for the good questions. I can't comment on Citi per se in terms of the recommendations, but from our own recommendations, when we did our valuations, I think our fair value was coming to about 32.72, and we had noted some of the risks that the business would be going through, but also some of the opportunities that are still there, right? Because as much as in the short term there are those risks, I think when you look at it from a long-term perspective, we are looking at recovery, business sentiment, opportunities in Ethiopia and the like. So short term there's going to be that pressure, but long term I think is a case for the stock. The other question was about Kabasid. Yeah, so what does Kabasid take over BSC for the counter? I think if you are looking at a strategy right now in terms of entry or exit into Kabasid, I think it is a bit too late, because this information has already been priced into the market, into the stock. And last year, Kabasid was one of the top gainers. I think it was up about 50%. So that information is already there. And I think if you have a strategy around that merger or acquisition, I think it is a bit late. But in terms of the businesses generally, I think for Kabasid, it is a good acquisition. It is a very related kind of business. BOC does industrial gases for industries, for medical purposes, and then Kabasid does carbon dioxide, basically for preservatives and the like. So I think it is a good strategic fit for Kabasid. The other question was about KCB entry into Rwanda have any meaningful impact on the earnings? In the short term, no. I think when you look at BPR, the bank they are acquiring, it will contribute about 4% to the group assets of KCB. And then in terms of profit, it's about 2 to 3% thereabout. So in terms of financial impact, in the short term, no. In the long term, I think you have to look at the economy of Rwanda, the opportunities that are there. It is one of the fastest growing economy in East Africa. They are doing a lot of business processes, restructuring, and you will always see it in the indices released by World Bank and the like about ease of doing business index. So it is an economy that is upcoming, and I think that is why not just KCB is investing heavily in Rwanda. Daniel, I think those were.
Yeah, thank you for that. I think there's also another set of questions for you. Kamau is asking, how does one invest in American, Chinese stocks, or even in South African stock exchange? And then besides Safaricom on the banks, which are other prospective long-term counters?
Yes, so this one is a tough one. American, Chinese stocks I have no idea about how you can go about this, but however, you can take the opportunity of the partnership we have with FX Pesa. I think they provide a platform whereby you can access some of these global exchanges and financial markets, including commodities, and all sorts of other kinds of securities. The question is, okay. Other stocks besides Safaricom and banks. Yes, as you have noted, is the biggest interest is basically Safaricom and the banks in our market. They tend to be the only sectors that are outperformers, and that's why the interest has been there. However, in terms of our recommendations, yes, you still see some very good value picks in EABL, in Kengen, as we have discussed today, and actually it was one of the top gainers last week. So you can diversify away from Safaricom and banks with those other two sectors.
Kamau is also asking, what does the Kabasid takeover of BOC gases portend for the counter? And then, which other interesting foreign investors besides Safaricom which other stocks are interesting foreign investors besides Safaricom and the banks? Gerald?
Okay. I think I've talked about both questions in terms of BOC and Kabasid. Kabasid has already priced in this acquisition. I mentioned that last year it was up about 51%, so a top gainer last year. So you cannot have a strategy around that merger at the current moment. Yeah, so the other stocks is basically what I've just mentioned, Kengen, EAPL. I think those are good value picks right now. Back to Daniel.
Thank you. Evelyn Kagai is asking, is it possible to buy T-bills from Rwanda? I saw they offer the best returns in the East African market. Gerald, Churchill, could you take this?
Thanks, Evelyn. I'd assume that there's a route that you can be able to gain exposure in the Rwandan T-bills market. And I don't have the details, but I assume that it will use the similar route that you can get into the Kenyan T-bill. So going to the Rwandan Central Bank or National Bank of Rwanda and get the documentation up and running. In regards to returns and in regards to the quantum that are issued, I still think that the Kenyan market issues, their weekly issues are still high at 24 billion, and comparing to even the regional markets, I think I've been monitoring the Tanzanian market. The kind of offers that they issue are quite low. I believe that the Kenyan market is still high. But in regards to exposure, that will be a best way for investor to gain interest, to gain access into the Rwandan market. And the other thing is that our policy rate is at 7%. The Rwandan policy rate is at 5%. So I'm assuming our T-bill, say the 364-day T-bill, is at 8.6%. So that means that the real return is 1.6%, the Kenyan market. So doing a better comparison, perhaps just to weed off the difference in return, is now to look at what yield is comparable yield is there in Rwanda, and then you might do the net off in regards to in regards to even the policy rates or the inflation rates, and then you can do the adjustments. So that will be a better metric to see which is giving a better rate as compared to just looking at the overall interest rate, that overall yield that are being offered by the T-bills in both markets. So back to you, Dan.
Thank you, Churchill. Gerald, Ben Nyamoya is asking, the largest banks, that is KCB, Equity, NCBA, COP, and ABSA, all listed banks really are the most affected by the restructurings of existing loan portfolios. CBK even suggested the 14.1% NPL exposure may raise to plus 17%. Are you still confident about our current fair value valuations, or should you expect a revision downwards?
Thank you, Daniel, and thank you, Ben, for the good questions. Yes, so you note that even before CBK had suggested about an increase in NPLs, we also had already seen this even from last year, because from the restructured book, which has already increased to past 50% of the sector book, we don't expect all that loan book to be performing once this restructuring timelines lapse. So we had expected, and we still expect NPLs to pick up. However, if this diverge significantly, because there's a lot of uncertainty about how the NPL performance will be, then definitely we'll have to do some fresh round of valuations. But so far, I think we are pretty comfortable with what our estimates are currently at. I think, yeah, I talked about uncertainty about, because even last year, there were surprises in terms of NPLs, in terms of provisionings, and we did adjustments accordingly. So we definitely have to look at what full year numbers will come through and how they compare with what our estimates are, and if there's significant divergence, then we'll have to relook at those numbers again. Back to you, Daniel.
Thank you, Gerald. I think more questions are coming to your way. Wilson is asking, is KenGen a good buy for the short term, say about 2 years? And then Alfonso Gutu is also asking, what are the prospects of KPLC counter in the short to medium term?
KenGen count on its long-term business outlook and investments. In the short term, you never know. There tends to be a lot of volatility, but if you're looking at the business, where it is investing, where it is committing its capital, what are the growth areas that it is pursuing, then the long-term picture is definitely positive. I think I've talked about All Career 1 Unit 6 coming on board in the next 1 year. Then in another about 2 years, again, there's All Career 6, a large power plant. So business investment is expected to be quite good over the long term. KPLC, what are the prospects of KPLC in the short to medium term? Well, very speculative. I haven't seen a positive story about how they are going to do their restructuring of their debt. Yes, they've talked about looking at the debt, extending maturity and the like, but I haven't seen some positive vibe around it. So there's going to be that volatility, and you'll see, at least for last week, there was a divergence in price between KenGen and KPLC, while KenGen was a top gainer, KPLC was a top loser. And you know, from historical patterns, they usually tend to move in the same direction, with KPLC being a leading indicator of where KenGen's price will be. So out of volatility on KPLC, they have a lot to fix, financial challenges and the like. So in the short term, it's a very volatile stock. Daniel, back to you.
Churchill, could you please go over the expected subscription rate for this week's T-bills in view of declining liquidity?
Oh, wow, that's putting me on the spot. It's really hard to really work the numbers in regards to what subscription will be, but a quick way of just getting a pulse of this is just look at the maturities, expected maturities in the coming auction. Coinciding with the coming auction, that is close to 24 billion. So CBK is seeking 24 billion, and then there's another 24 billion that is maturing. So, but because of the heterogeneity amongst the investor class, you'll find that some people may just opt not to roll over into the next sequence of issuance, and start looking out of opportunities, perhaps in the secondary market, or get into some other asset classes. So it's really hard to work the expected numbers. But if we foresee the liquidity trends that has been tight the last 2 weeks or so, it will have a dampening effect on the T-bills auction this week, coupled with the fact that there is a coinciding T-bonds auction that will be held a day earlier. So all these factors are pointing that there's a higher likelihood that there could be a lower subscription in the T-bills at this week's auction.
Thank you very much. Charles Oma is suggesting that we could have an educative session on how to file our returns we get on interest and dividends earned on the money market and stock markets. I think this is a good idea, and we are going to incorporate it in the next briefing, where we can maybe take you through on how to file the returns of the dividends and interest earned on money market fund and stock market. Stephen Karinga is asking, any comment on NMG shares? He's heavily invested in this. So Gerald, maybe you can expound more on this.
Yeah, thank you. I'm not very good with the media stocks. It is one of the stocks that we don't have very active coverage on. However, if you look at basically the changes that have been there in the media industry, and NMG, most of their revenues was coming in from the print division, and the changes that technology has brought about in terms of consumption of news, consumption of adverts and the like, you see has been a lot of pressure for them to diversify away from the print division. But I don't know how their digital strategy is, how strong it is currently to replace the print division. I think it's something that will take a bit of some time to monetize, and also to be an effective replacement of that key line. So I wouldn't be very good in terms of giving you advice of how the stock will be trading, and how it's going to be in the future.
Thank you, Churchill. Joseph Areu noticed that no one talks about corporate bonds anymore. What could be happening in this sector?
Thanks, Joseph, for that candid observation. In regards to the total stock of corporate bonds against the whole portfolio of domestic bonds, is quite low, should be even less than 1%. And in actual turnover, I was just seeing the statistics from the quarterly CMA bulletin. It has been lower than 1% for the even pre 2015 years. 2015 is quite pivotal in regards to corporate bonds. That's when we had some issuers who were quite significant in corporate bonds. This is Imperial Bank, and it fell, it went under, and it had a dampening effect on corporate bond, and followed by Chase Bank. It had issued a 7-year bond in 2015, should have been maturing next year, but also its failure had a dampening effect on corporate bonds. I'm also, because of this issue, because most people who invest in corporate bonds think that at least they are secure, they're secure asset class, but shock on them when the whole resolving of those banks' issues did not address the corporate bonds of those banks. So that has had a spillover effect on the whole corporate bond segment, to the extent that there haven't been as successful issuance post 2015. Right after, I think 2015 is when one bank, Family Bank, raised but they were seeking 5 billion. They're not able to get the full amount. And last year we had 2019, 2020, early 2020, we had the successful issuance of Econ green bond, but its success was pegged on the guarantee that was placed by Garantco. So we are seeing that most investors are still cautious in getting in the corporate bond unless there's some element of guarantee to secure the investments. And further down the line, we saw last month Centum, who is a repeat issuer in the corporate bond, having retired its bond in June, coming back 6 months later in December, but it was different. They issued a zero coupon bond, and it was targeted to some select investors. It wasn't open to the whole market to come into that. So these are the factors that are pointing towards a death in corporate bond. But unless there's a clear resolution to the legacy issues that has played out in the corporate bond segment, and also that at least there's that element of guarantee for the investors. Remember, some of these investors who have primarily invested in the corporate bond, some of them had invested in the commercial paper segment. A commercial paper was dominated by Nakumatt. Nakumatt fell over, so it's somehow related. If the commercial paper is not addressed because it's unsecure, and then we find that the corporate bond segment is also unsecure, it just dampens the investor confidence in those segments. So unless we get a clear resolution on some of these issues, we might find that corporate bond will just be on its death knell once the existing corporate bond papers just matures, and we may not even have a vibrant corporate bond issue. So that's why we just focus on the other segment of the domestic bond as opposed to the corporate bonds. I hope that addresses Joseph's query.
Okay, Kamau is asking, Centum is grossly undervalued according to Chris Kirubi. What does this recent massive buy of shares in the open market portend? Gerald?
Thank you. Yes, if you look at the price to book of Centum, it's about 0.2, 0.3 times. So definitely a case of undervaluation. Whether investors will follow Kirubi in buying the stock is, it's anybody's guess. I think this announcement came in the early part of last year, but we still see the stock come under pressure over that duration of time, and recently locking in some all-time lows. So I wouldn't say that investors would start piling up on Centum just because of that. Back to you, Daniel.
Lastly, could you maybe talk about commodity stocks? That is from Clement Karanja.
I don't know about those. We don't have them locally, commodity stocks, miners and other kinds of extractive industries. So I'll not be very good in terms of those, unless Churchill will be. Sometime back you were looking at commodities, oil and.
No, we don't have exposure in those commodity stocks locally. Perhaps as what Gerald has mentioned, in the other markets where there are the different underlying commodities, be it gold, be it oil, that's where the exposure is in those companies that are directly related in those sectors. But locally, we don't have any direct. Arguably could be Total being in the oil pipeline value chain, but still is not a commodity stock in the strict sense of commodity stocks. Yeah, so back to you, Daniel.
Okay, thank you very much, Churchill and Gerald. And for all attendees, we'd like to thank you once again for choosing to spend time with us and learn more about what is happening in the financial markets. We aim to give you more updates, that is via the earning notes, the topical notes that our research team sends out via mail. Be sure to also download our application called Jikuze, where you can be able to buy and sell shares and also invest in the money market fund that is GenCap Hela Imara. And we'll be sure to see you in the next week. Have a good investing week. Thank you very much. My name is Daniel Ogeto.